Okay, hi everyone. This is going to be the first lecture for Chapter 17. We're dealing here with accounting for income taxes. Thus far we've talked a lot about corporations, right? We talked about they file the 1120, there's book to tax differences, and we looked at their formation, their operation, and then when the corporation ends. So as I have here, right, most items of income, our revenues and our expenses, are included in our PTBI, right? If you were to look, at our financial statements, right? Now, however, as we've discussed in the past, there are temporary and permanent book to tax differences. We have to consider these when on our financial statements we're producing our income tax provision and we're looking at our deferred income taxes payable. So whether we're going to have a deferred tax asset or a deferred tax liability. So it's kind of the combination of the income tax provision on the income statement and then what we're going to have on our balance sheet to recognize any future deferrals or taxes we're going to have to pay. It's a little confusing, so just bear with me here. Overall, the idea with this, what governs this, is ASC 740. So it's FASB ASC 740. And what we're talking about, at least right now, is the financial statements, right? If you remember in your 281 course and you remember the multi-step income statement, recall that it's not just your revenues minus your expenses. There's a lot of, as it were, stop signs along the way. So you might have your operating income minus your operating expenses. Then you get, you back out your other income, your other expenses, and then you get to that PTBI number, right? The pre-tax book income. It's basically your net income before you subtract out your income tax expense. So that's what we're looking at here with ASC 740. When we're doing that income statement, we're putting our provision for income taxes. How do we calculate that amount? ASC 740 governs the rules for this. Now, the one thing in practice, right, you can have all different sizes of corporations depending on the firm you work at. Some of the very large firms, right, if you're like a big four firm, they will have entire teams who just specialize in ASC 740. It's like the only thing they do because this is such a complicated area that you would have to kind of specialize it or be an expert in it. So as we've discussed, right, and again, this chapter is meant to be just an exposure to this. It's a survey course. This is not an entire course on provisions. It's just a introductory matter. So we're starting with GAAP, right, which is issued by FASB. So the Financial Accounting Standards Boards, they make GAAP, which are kind of the rules of accounting. And GAAP says, hey, you have to put a provision for income tax expense on your financials, on your income statement. And the provision is basically going to be how much current tax expense you have. And then as well, what are the tax effects in the future in light of temporary differences? So it's kind of, right, what's going on now, what's going on later. The stuff that's going on later, right, in light of temporary differences reversing, whether it's favorably or unfavorably, those are going to be deferred tax liabilities or deferred tax assets on the balance sheet. So this is a combination of the income statement and the balance sheet. So this right here is just showing, a company, right? We have WWE. This is their Form 10K, right? We would be looking at their income statement right here. Hey, here's their PTBI right here, right? Their pre-tax book income. So, hey, it's all our income before we back out our income tax expense. This right here is the provision, right, for income taxes. So it's like 17,000. This is like in millions or whatever. I mean, these much larger numbers, but they shorthand it to that to make it more easily readable. The idea with it, though, is like, how did they calculate this number right here to put for provision income taxes. If you can think of a provision work as simple as that, like we're looking at our financials, we're looking at our income statement, we're trying to figure out what we put for this provision. That's what this chapter is all about in a nutshell. So ASC 740, right, we said those are the rules by FASB. It's the provision that guides us on how to do this. Basically applies to income taxes levied by the federal government, U.S., state and local governments, and other governments. So basically all we care about here is anywhere you have a tax that's based on income, that's going to come into play when we calculate your income tax expense. Other taxes, so like franchise fees or maybe gift taxes, if there's another tax applied to you, those are expensed out basically before you reach the PTBI number. So when we're dealing with the provision, this is just the provision for income taxes, namely taxes based on income. Now, the overall objective with this ASC 740 is going to be to figure out what our current taxes are from the current year versus how much is going to affect our later years. So here's the idea at a very high level. Maybe you, as a business, make $100,000 of income, right? Some of that, the tax expense, we may recognize in the current year, right? Others, other amounts of that tax expense, we're going to recognize in later years. The reason being is there may have been a temporary difference that's going to reverse over time. So we're going to have a kind of a difference between our book and our tax. To the extent we have current year tax expense, that's going to be recognized now. And then on the flip side of that, to the extent the stuff reverses over time because of those temporary differences, the things we recognize later, we're going to put on the balance sheet as a deferred tax asset or liability. So that's kind of the idea with it. And then as it reverses over time, then we could update accordingly. So because they use this combo of current taxes plus the balance sheet for those deferred tax assets or liabilities, ASC 740 is known as the balance sheet approach. Now, to compute a deferred tax asset or liability, a company calculates the future tax effects attributable to temporary book-to-tax differences and tax carry-forwards. To the extent our temporary differences are cumulatively favorable, that is to say, in the current year, it causes taxable income to be less than book income, we're going to have a deferred tax liability. Likewise, to the extent temporary differences are cumulatively unfavorable, that is to say, in the current year it causes taxable income to be greater than book income, we're going to have a deferred tax asset. Let's just think of a very simple example here, right? Because this is kind of like theoretical right now. This may be hard to think about, right? Let's just use depreciation, right? Let's say on your tax return, you're going to bonus 100% depreciation the item, right? Let's say it's a $100 item, you take all $100 expense in the current year. However, on your books, you're just using straight line, you're going to depreciate it, $10 a year for 10 years, right? Well, we know if that's the only temporary difference, right? If we just look at that in a vacuum, that it's going to cause our taxable income in the current year to be less than our book income, right? We have way more expense because we're fully depreciating $100 on our tax return than we will have on our books and records. However, remember when we talked about book to tax differences, how these reverse over time, in the future years, as this reverses, that is to say we get the 10, 10, 10, 10, on our books for the yearly depreciation expense, and in those years we get 0, 0, 0 on the tax return because we've already expensed it, we're going to have a deferred tax liability on our balance sheet. In other words, we're going to recognize this future kind of frowny face every year where we get a deduction on books that we don't get on our tax return. We're going to recognize that on the balance sheet as a liability. Now, the reverse would be true for a deferred tax asset. If things, over time are going to give you a smiley face, right? You're going to get a benefit on your tax return, then we're going to recognize that future benefit now as an asset. So if you can just start in your head with the simple example of depreciation, here's the idea: in the current year, you take more depreciation on your tax return than your books. Oh, looks like we got an email here. If you take more depreciation on your tax return than your books, right, that's good. But in the later years, you're going to get the flip side of that. That's not good. In the later years, you do all this stuff on your books that you don't get on your tax return. We recognize all that later year stuff now as a liability. So just, if you want to start with that, that might be an easier way to picture this. So if we go to 17.1 here, they're showing us, it looks like a balance sheet right here. And going down, they're showing us our deferred tax accounts at 12/31. So these are basically the deferreds, right? Those things that are going to reverse over time in the future that we have to put on our balance sheet now. Now, it looks like they have some deferred tax assets. They have some deferred tax liabilities. However, when you combine the two, you're at a net deferred tax liability. So in other words, we have more DTLs than DTAs. So in this case, our company is going to have net, cumulative, favorable, temporary differences. Because we're in an overall favorable position, this basically means that our PTBI in the current year is going to be greater than our taxable income in the current year. So basically, it's cumulatively favorable for purposes of the current year, but in future years, it's going to be unfavorable. That's why we have, a net DTL here. Current year good, future years bad. Recognize those future years through the DTL. This is just, showing you that. So we have here kind of a multi-layer process for the provision. The book gives like 6 steps. I'm going to try to, in the third lecture, whittle it down to 3 steps, but we can talk about it here to give you, a more precise overview of it. So basically, anytime a company computes its provision, right, there's going to be 2 components of it: a current amount and a deferred amount. What you're going to pay now in tax versus what you may have to pay later in tax in light of those temporary differences. Overall, when we figure out what our income tax provision is, right, it's going to be the combination of the two. So CTE plus DTE equals our total income tax provision. How we actually calculate that, right? The book gives us 6 steps. The first thing is we're going to adjust our pre-tax book income for perms. Then we're going to identify temporary differences, calculate our current tax expense, right here, determine our ending balance for our deferreds, our deferred tax asset, deferred tax liability, see if we have to have a valuation allowance, and then calculate the deferred income tax expense or benefit. So basically, right, we do the CTE, we do some steps to get there, and then we do the DTE, the deferred tax expense, to get there. Basically, if this is the overall idea with it, there's 6 steps to helping populate this. We're going to go through the first 2 or 3 now. Whenever we do the problems in the video, like the third video, I'm going to whittle it down to like 3 steps. So the first idea here is you want to get, when you're trying to figure out the provision, right, the first thing you want to do is recall that there's a difference between temporary and permanent book to tax differences. Temporary is when you pay the tax, right? Do you pay it now or do you pay it later? Permanent book to tax differences in distinction are whether you pay the tax, right? I mean, M&E or something, right? That could be always a 50% difference. Muni bond income. That could be a permanent difference, right? So it's when versus whether. Sometimes you may never pay the tax on this. Sometimes you may kick the can later down the road, right? Just, we've talked about temporary versus perms. Some examples here of permanent differences, right? Tax exempt interest, muni bonds. We've talked about this. It's not going to be taxable on the tax return, but on the books it will be. Non-deductible fine, so that's the reverse. You can get a deduction on books, but you don't get it on your tax return. The other thing here is, the DRD, that's like just something that you would only get for taxes. In short, when we're talking about our provision and computing our provision, we have to be aware that the company is basically not going to take permanent differences into account when we're computing our balance sheet for purposes of the deferred tax asset and deferred tax liability. Basically, what they do instead is they're going to enter this computation on the tax return, and it's going to be part of current tax expense. So that's the idea with it, is with perms, it's part of current tax expense. And the idea here that we'll see in the third video is that it will affect the ETR, the effective tax rate, and we have to use the perm differences when we do our recon from our statutory rate to our effective tax rate. Again, this might be better to watch this video, then watch video 3 and come back and see this again. So let's look at 17.2 here. This just says, hey, what are the permanent differences and are they favorable? So, hey, we have some tax exempt interest, life insurance premiums, a DRD. Overall, when you net them, right, we're at a net unfavorable permanent differences. (17.3) here says, what's going on? How do we use these permanent differences? Basically, you adjust the PTBI for them, the pre-tax book income. That will increase it here by $138,000. Again, permanent differences, we just adjust the PTBI. It affects our current tax expense. It really has nothing to do with our deferreds, the deferred tax asset or deferred tax liability. This here is just showing you a recon from book to tax. You have your book income. You would make your adjustments accordingly here for book to tax differences. Then you would have your taxable income. You then would go through and you could identify from these book tax differences which one are permanent differences. You then would adjust your PTBI for those. Step 2 here, right? So again, we're talking about calculating the provision. We said what we care about is we're trying to calculate this guy right here because this gives us our provision. We said the first thing we want to do is take our pre-tax book income and adjust it for the permanent differences. Next, we're going to look at the temporary differences, right? So basically the idea here with the temporary difference, it's the difference between the tax basis of an asset or liability and its reported amount on the financial statements. It's basically in the future going to result in taxable income when reported as an asset or if it's a liability as settled. So what are some common scenarios here? So we can look at these. They're more specifically broken out here from temporary differences. So if we have temporary differences that are revenues that are taxable after they're recognized in the financial statements, they're going to be considered favorable. So for example, an installment sale gain recognized in the sales year on financial statements, but on tax year are recognized over the collection period. Here's the idea with an installment sale. Let's just say you sell something where they're going to make multiple payments to you. Hey, buy this for me for $100. You can pay me $25 a year. My basis in this thing was maybe $60. So, I sold it for $100. My basis was $60. I have a $40 gain. On the financial statements, you recognize that $40 gain in the year of sale. However, on the tax return, they say, no, you don't do that. You wait until every time that person pays you $25, you recognize a portion of that gain. So this would be an idea where a revenue, right, it's taxable after it's recognized on the financial statements. We recognize all of the $40 gain now on the financial statements from the sale. Later on, it's going to be taxable. The reverse situation here, where we have revenues that are taxable before they're recognized on the financial statements. So basically, the most common example here is prepaid income. Basically, the idea with this is, if you remember your financial accounting class, if you have prepaid income, you're going to debit unearned income, or I'm sorry, you're going to debit cash and credit unearned income, that liability account. And then when it's recognized, right, whenever you earn the income, you would debit unearned income, reverse it out, and then credit revenue, right? It's not the same for taxes. Taxes basically say, prepaid, if it's cash in, it's taxable then. So if you get prepaid income on the tax return, it's going to be taxable now. But on your financial statements, it's going to be taxable later when it's earned. That's why these are revenues that are taxable before they're recognized on the financial statements. Two others here. We have expenses that are deductible after they're recognized on the financial statements. So the idea here is you would have expense first on financial statements, and then in a later year, you would have expense on tax return. So things like bad debt expense, warranty expense, accrued compensation, vacation pay. Basically, on the financial statements, we can accrue these and take a deduction now. However, the tax return says, no, you can't accrue them now. You can only deduct them when you actually pay them. So it's later. So that's the third type, expenses that are deductible after they were deducted on the tax or on the books. So the fourth one here are expenses that are deductible before they are deductible on the financial statement. So deductible on the tax return before deductible on the books. This would be like the classic depreciation expense, right? Where you do that accelerated depreciation on the tax return, expense the whole thing now. Later on, you're going to expense it on the books and records, commensurate with that depreciation schedule. So you can see, right, how these, the setup of them and how they would create here, right, whether it's a deferred tax asset or a deferred tax liability. So with depreciation, right, you get all the benefit now, but later on you get all of the burden as that reverses over time on the books. So you got to recognize that burden as a deferred tax liability. In distinction, right, let's look maybe here at a deferred tax asset, how this would create it. We said prepaid income is taxable when received, so we got the burden now, but later on when it reverses and we get the benefit of recognizing having it be recognized on the books but not on the tax return, that whole benefit has to be recognized as a deferred tax asset. So this is just showing you again, the adjustments you would make, and then you would identify them as temporary book to tax differences. So they have here, once we identify them, there's basically two. We have taxable temporary differences, and then we have deductible temporary differences. And we've talked about some of them so far. So they say here, this is where they use this balance sheet approach, where the financial basis of it is going to be greater than the tax basis, or the reverse. Basically, the idea with a taxable temporary difference, if we go through and we were to look at these, I have the future tax cost associated with a taxable temporary differences recorded on the balance sheet as a liability, a deferred tax liability. As a taxable temporary differences, These are going to reverse throughout time, and it's going to cost us tax in the future. Therefore, we're going to place it on the balance sheet now to recognize this future cost as a present liability. Right? So these would be, when we looked at, the first thing we did is we kind of said, okay, here are 4 different types of temporary differences, right? We can put them into one of 2 buckets. One is they can be a taxable temporary difference, or 2, they can be a deductible temporary difference. If they're a taxable temporary difference, they're going to basically give rise to a future income, which is going to create a deferred tax liability. So, for example, here, if we use the tax depreciation, this is always the simplest one to begin with. In these cases, right, excess tax depreciation over book, basically the idea here is in the future, while we get the benefit now, in the future we're going to get a taxable income. So that's why it's a taxable temporary difference. In the future, this is going to create taxable income when it reverses unfavorably. And then we recognize that as a DTL, right? We're basically just, taking these guys right here, right, like DTL, DTL, and we're calling them taxable temporary differences because in the future, they're going to cause a tax liability. In distinction, the remaining 2 from here, right, they're going to be considered deductible temporary differences. So in the future, while it's not good now for us on the tax return, in the future it will be good, and we have to recognize that as a deferred tax asset. These are, these guys right here, right? So basically, revenues that are taxable before recognized on the book. So if you have prepayments, right, taxable now, in the future, you get to exclude it from your income on your tax return, even though in the future you may report it as income on your books. That whole concept of that, future benefit is going to be the deferred tax asset. So let's pause there for the time being. We'll pick it up with calculate current tax expense. Again, this is just laying the framework with it. The 3rd lecture will kind of give this some more specifics as to how we're going to proceed on it. So we'll see you in the 2nd lecture.